Hi, and welcome to my free training on using our trading calculator so you can see and understand some mathematical concepts on risk management, stuff that probably no one shared with you before, stuff that you probably don't know, and relatable ideas and concepts around it, but also things like compounding, break even win rates, drawdown recovery, spectrum of losses, etc., etc. So let's get straight into it. This is a bit of a summary page on the trading calculator. To download this, by the way, or to get the link for it, click the link below and that will come through to your email address. Okay. So first part is this part on the tool column below. Now you would have to enter some of your strategy statistics here from your own backtesting or automated trading results, which is what we do. But whatever you've got, right, we need some information here on your overall strategy. Now, a lot of people will say out there, trade 1% per trade and you'll be fine. Well, that's totally flawed. And it's flawed because they don't know how much you're willing to risk in terms of maximal drawdown. And they also don't know the win rate of your strategy. Okay. Now, the two examples I can give here are one, if you had a coin and you were tossing that coin, every time you got a heads, it was a winning trade. Every time you got a tails, it was a losing trade. Now, we're going to win 50% of the time over a spectrum of trades, okay? But we are still going to encounter a losing run. And that losing run, if we were to have a 50% win rate strategy, the losing run's going to really hover between 4 and 8. It's very likely that we're going to see a losing run of 4. It's unlikely that we might see a losing run of 8, but it's still possible. Now, there's two levels. Mark Douglas covers this in his book. There's two levels of probability: what's probable and what's possible. Yeah, so what's probable here is a losing run of 5, but what's possible is a losing run of 8. Okay, now that's on a 50% win rate strategy. Now, a lot of people don't comprehend or factor in their probable losses within their risk management and their psychology. So after losing run number, consecutive losing trade of 3, 4, or 5, that trader is actually considering stopping that strategy. Doesn't work, I'm going to move on to the next thing, which is totally flawed. It's also why traders who trade things like SMC struggle as well, because that's an incredibly low win rate strategy where you're going to have so many losing runs that you have to be mentally there to absorb it. And you also need to have the cash flow to absorb it. But if you don't, you're going to have a risk of ruin situation where your account is blown. Also, the psychology and the stress of that happening, unless you plan for it. So let's take rolling a 6 on a dice, okay? Now, rolling a 6 on a dice mathematically is only 16.67% probable. Now, if I gave you £100 every time you rolled a 6, but you lost £10 every time you rolled a 1 to a 5, you have a statistical financial edge on the markets. However, if we plug this in from a probability perspective, there's a probable losing run of 18. How many times have you played snakes and ladders and never got a 6? Or sometimes you get a few 6s on the bounce, yeah? But you have to plan for those losing runs. So a probable max losing run would be 18, but one day you might get 29, yeah? Back to the heads or tails, I think the biggest losing run in roulette, I think something like 14 on the red or black thing. So these things happen. It is pure maths. But this isn't shared a lot, and a lot of people don't factor this in. Now, if I was trading a 1 to 6R strategy and I knew that I'd planned my risk management in line with a losing run, then not only is my bankroll protected, but also my psychology and mindset's on point. For example, here I've got a probable losing run of 18, a very likely losing run of 15, and an unlikely losing run of 29. So if I've got £10,000 and I only want a drawdown, a maximal drawdown perspective on that, if my biggest losing run was to ever happen, a drawdown of, let's say, 15%, then I might look at these and go, do you know what? I'm comfortable that that's going to be very unlikely, but these are probably going to happen. So I'm going to choose somewhere in the middle and risk a losing run of 20. Yeah. Now, that's going to tell me that my risk per trade is 0.75%. If I just traded that one strategy within this drawdown level of 15%. Now, it might be that you've got 3 different strategies, all with different win rates and data, And if that's the case and you only wanted to risk 15%, then you might only give this 5% of that 15%. So you've taken your maximal drawdown and you've diversified your accounts. On that basis, you would only risk 0.25% on this strategy. Okay. So this is a really cool concept to be able to for you to get your psychology on point, but more importantly, your risk management and your account structured correctly. Because back to the dice analogy, if you started with £100 and you encountered that losing run where you lose £5 for every strategy and you had a losing run of 20 trades, you've blown your account. Yeah. But if you had a winning run early with a couple of sixes, your account's way into the black. So understanding your risk of ruin, your drawdown recovery, and things like that is also key. So that's stage one, really, with this tool. We've also got things like a brief compounding calculator on here, the power of compounding your account on this main tool page. Now, another thing to consider here is the more trades you have, the more likely you are to see that bigger losing run due to the fact that there are more trade scenarios, there are more iterations of that probability. If I only toss the heads or tails 20 times, my biggest losing run might be 2 or 3. But if I did it 2,000 times, I've got a bigger spectrum of trades losing within that time window. So this just shows you that in a visual sense. Losing rate 50%. We're going to see a high probability of losing 2 to 3 trades here, but a lower probability of losing 7 or 8 trades on the bounce. There's 3% chance, 1% chance, less than 1% chance. But as we increase the trade volume, those levels increase. Okay, good visual tool just to get you on track there. Now, also, we've got something called drawdown recovery, and people sort of forget this within this, but it's covered within this calculator. So let's say you've got 1,000 account and you draw down 50%. Then you've got 500. To get back to where you need to be before you started, you've got to then double that account. Okay, that's why it's really important that when you're planning your strategies and your drawdowns and your risk management and your probability of losing, that you stay within a very sensible recovery point. Yeah. So if you were to draw down your account by 10%, you only need 11.1% to recover. If you draw down by 25%, it's 33. But as soon as you get to that 50% level and needing to recover by 100%, things get very, very tough. Okay. Now, compounding. Again, some people are aware of compounding, but even though they're aware of it, they lose the discipline to think long term. They think long term, but if you're anything like how I was at the beginning, where you start with a small amount of capital, you're obsessed about flipping that account or trying to push the risk to try and make a load of money, and you end up just blowing it. Whereas if you'd have taken the long-term view and started small, those gains would have compounded over a period of time, which would have put you in a great situation. So this tool can also be used to keep you on track and to keep you journaling monthly or weekly to see if you're on track for those returns. Because ultimately, if you had, let's say you've got 2,500 and you want to plan for a monthly gain of 6% on average, and a monthly top up, let's say you top up from your 9 to 5, 150 a month. Now, your first 2.5 grand, your first month, you've only made 150. Yeah. Sometimes that wouldn't have covered your costs for trading, your VPS, your membership, your community, your whatever it is you're trading. So some people are like, I'm not making enough, but they're not giving it enough time. Because actually, your first 12 months, every single month is going to be quite small, especially if you're starting with something like 500 or 1,000. Yeah. However, being disciplined in using this as a framework for monitoring your progress against the long-term goal is really, really important because, month 60, 5 years on, if you've been consistent along that, the compounding effect, the eighth wonder of the world, Einstein called it, has meant that you've made money on top of the money that you've made. And you see this whole compounding curve. Okay. The beauty of compounding is as well that every time you lose, the monetary figure on consecutive losses drops because the value of that money also drops as your account goes down. Okay. So using a percentage of risk per trade instead of a fixed lot size is the way to trade because of those reasons. Okay. Now we've also got break-even win rate here. Okay, so if you've got one-to-one risk to reward, obviously you need at least 50% of trades to win. If you make 51% of them winners, you've got a financial edge on the market. But this is just something to help you see that if you're trading a 1 to 10R strategy, yeah, you only need to be right 9.1% of the time. Same with the 1 to 17, 16%, 17% win rate on rolling a 6. There's a mathematical edge on that, okay? If you've got the 1 to 10 risk to reward. So you can see here, you can enter your own statistics and see how that affects these numbers. So you've got a very disciplined approach to your trading process. Strategy log 2. So you can use this to keep track of your journaling, your pairs, your trading rules, etc., etc. The main thing here is to give you some value over managing your risk more accurately. Download the tool below if you've not done already, and hopefully this helps you be more disciplined, have a long-term view, and make sure you're planning not only in your mind, but on your trading account balance to factor in those losing runs that are always going to be inevitable at times.